Well, hello from warm Minnesota. Just let the temperature go up one more degree, but let's get started. This is George Steele, Marketing Manager at U.S. Advisors, welcoming everyone to our webinar dedicated today to sharing insights on hybrid long-term care products and the latest market trends. U.S. Advisors taps nearly 70 carriers and leverages countless products to deliver the best solutions for your clients. Today, our featured presenter is John Thomas, Regional Vice President for Securian Secure Care. You'll soon appreciate why Secure Care's innovative and well-communicated LTC platform has earned a special place on our solutions menu. Now on your screen now is contact information for myself and two key members of our marketing team. Andrew Casilius, a fellow marketing manager who's made enormous contributions to U.S. Advisors' growth, helping clients create diversified financial plans. And our senior leader, Rod Crandall, Chief Marketing Officer, whose consulting philosophies have become the cornerstone of our agency service model. U.S. Advisors' insurance agency goal is to help you intentionally integrate insurance and planning products, including life, annuities, long-term disability, and of course, long-term care insurance into the overall plan. Now, our promise of excellence is closely tied to the carriers and category specialists we partner with. So I'm very hopeful you'll find today's presentation educational, but also will stimulate actions to address the rapidly growing need for long-term care. We're very excited because the sales opportunities are simply huge. John, thank you for supporting all our efforts. I'm going to hand the floor to you.
Thank you, George. I appreciate that, and thanks for the introduction. And yes, as you mentioned, we have a special. I think you said we're a special carrier, and I appreciate that. But we have a special partnership, and so yes, U.S. Advisors is a fantastic partner of ours at Securian, and so I'm thrilled to be with you all today, and thank you all for hosting me. Get moving. So Securian Financial, if you are not familiar with Securian, we are Minnesota Life Insurance Company. So Minnesota Life Insurance Company has been around for 140 plus years, and Securian Financial is the umbrella company of Minnesota Life. So you may not have heard of us under the Securian umbrella name, but probably Minnesota Life Insurance Company, and we are the 8th largest insurance company in the nation. Serve more than 21 million customers across North America. So we are a sizable insurance company. Really where what I'd highlight about the company is our ratings. And so we are a mutually held company. We've got fantastic ratings from AM Best and Fitch and Moody's, and a Comdex of 96 out of 100. And I really mention that because as a mutually held company and one with strong and stable and great ratings, as a insurance carrier, we deliver insurance policies to our consumers and our clients, and that really is a promise to deliver on a future need, right? And so as you represent a company and you sell a policy to your clients, you want to know that that company is going to be around to deliver on those promises in the future and deliver on those policy payments. And so it is important to be a well-rated and well-rounded company, which Securian Financial is. And so our agenda, I'm going to talk a little bit about COVID-19 and really concerns, individual concerns as well as market concerns, and how caregiving has changed over really the last year and a half. A brief bit about public LTC on the horizon and some insurance trends that lead to a phenomenal opportunity with Secure Care. There are several carriers in the market, but I think Securian is really well positioned with a leading solution in the market right now. And I'll talk a little bit about why we're a leading solution and how this might be a good fit for your clients. But as we all know, COVID has been a traumatic and difficult pandemic for us all, right? But particularly for nursing homes. And so there were nursing homes are hardest hit by this pandemic. As you see here, a majority of deaths were in nursing homes. And many of you probably personally experienced this. I had two family members pass away in a nursing home over the past 12 months. And so, I know many of you are in the same boat and understand, and many of our clients, consumers are in the same boat. They've had family that's been in nursing homes. They understand and saw on the news every night the risk in nursing homes. And so it has changed some of the conversation about elder care and really what is the best type of elder care, right? Beyond just folks that passed away in a nursing home, individuals were trying to get out of nursing homes as they could, right? I had family that left the nursing home and stayed with family members. For anyone that had family, and for folks that were able to get out of nursing homes, they were. Nursing homes and facilities saw the biggest decrease that they've ever seen historically. Nursing home occupancy went from 80% in over 12 months to early this year down to about a 67% occupancy at its lowest. And so there is a conversation that's happening. I was at my grandfather's funeral actually this several months ago, and the conversation with family was, this nursing home thing is terrible. How are we going to make sure that we don't end up in a nursing home? Right. And that was the conversation many of my older family members were having around the table after the funeral. And so there is a unique opportunity to have a planning conversation right now. We're open to talking about it. We need to talk about it. It is a top concern for individuals right now because of COVID and the lasting effects, right? And so not only just the societal effects, nursing home effects, there are long-term effects from COVID itself. The Mayo Clinic put out some fantastic research recently, and they're looking at the health effects, long-term effects on individuals, not just those with serious cases of COVID, but even those with mild to medium cases that didn't require hospitalization, right? They're showing that this COVID virus stays active in the body, and it resides in your organs. It resides in your heart. They're finding it in the lungs and in the brain. Imaging tests are showing for even mild COVID cases that folks have increased risk of heart failure down the road or heart complications, scarring in the lungs that creates long-term effects and issues, or even COVID that's staying in the brain tissue. They're seeing increased risk for strokes and seizures in even mild cases, and potentially the risk of developing Parkinson's and increased Alzheimer's and dementia down the road. And so not only are we having to talk about what our plan is for aging and elder care, but also whether or not we have an increased risk for needing care. Right? Do we have an increased risk? Did we contract COVID and have an increased risk for chronic illness down the road? And so these are things that may create a higher susceptibility to chronic illness and chronic care need, but also an opportunity right now for us to have a crucial conversation, a needed conversation with folks to help them in this planning process. I often say, I think up until a year ago, folks were primarily concerned with what I call phase one of retirement planning, right? Phase one is you work your whole life, you think about retirement in your late 60s, and what am I going to do? I'm going to travel, I'm going to go play golf all the time, I'm going to live my life and enjoy this period of time, and all of our retirement savings and retirement planning is to that effect. What kind of income do I need to enjoy this period of time? But then there's the phase two of retirement that we don't often talk about. That phase two is when we start to slow down, right? We can't move around as much. We can't travel as much. We start to need care. It often involves family, but it often also involves paid caregivers that may come to our house a couple times a week to help out with care of our bodies, but also care of our home, right? And that creates an increased income need to meet those challenges. There's a fantastic study from ARP that came out in 2020, and they look at, and it's an extremely exhaustive study, but they look at caregiving in the United States. and they've looked at it historically over the last several decades, as well as over the last 5 years. And something interesting is that chronic illness, increases in chronic illness have increased significantly in the last 5 years, to the point where the care need is increasing significantly. You'll see on that table here, there's been a 29, almost 30% increase over from 2015 to 2020 in the amount of folks that need care for longer than 5 years. And so in 2015, it was estimated the average length or duration of care was 4 years. They've increased that to 4.5 years because of this 30% increase in people that need care for longer than 5 years. And so this has been the most significant increase that they've seen in some time. And so, of course, we know that all these baby boomers are entering this period of time where they're starting to age, right? We've got these increases in chronic illness. Alzheimer's disease has increased 70% in the last decade. And so you have all of these things, along with these increases in medicine that help us live longer. All of these things contribute to this lengthening need for elder care. So you combine that. Yes.
And John, I was going to say, this is almost like a perfect storm, because in addition to the statistics showing that the length of care is going up, you also have the cost of care going up. So that could potentially be a devastating effect to your clients and their financial portfolios. So again, as you hear this presentation, think about 2, 3, 5 clients where you can have this conversation and discuss how that a sliver portfolio can be maybe repositioned into the solution that John will get into here next. Thanks, John.
Yeah, no, thank you, Andrew. You're exactly right. The cost of care is going up, like medical care costs are going up significantly, far outpacing inflation, as we all know. Any study you look at on retirement success, the biggest risk to a successful retirement outcome for anyone that has otherwise adequately prepared are long-term care expenses and medical expenses. So that really is the most significant risk to someone having a successful retirement outcome and meeting their retirement goals. One of the other, I think, valuable pieces of information out of this study is they looked at folks that are receiving care currently, and asked the question, did you have a plan for future care prior to getting in a position of needing care? And you'll see here for the care recipient, almost 40% of people did not have a plan for receiving care prior to ending up in that situation. For their family that's providing care, in most cases, 54% of those family members didn't have a plan of how they were going to care for maybe their spouse or their parents or loved ones that are in this situation, right? So, this is something that we don't all think about. We kick the can down the road and we assume that we're going to live a long, full life and be able to care for ourselves. But a majority of people, are almost half of individuals, end up in a situation where they weren't prepared for the care that they end up needing. And so it is valuable for us to initiate this conversation. And regardless of what the solution ends up being, it might be the secure care solution, it might be something else, but a plan is necessary. So that families are adequately prepared for success in these elder years. I'll mention the Washington State program. This baby boom increase, and as baby boomers are aging, the states, the federal government, you've probably heard quite significantly that there are concerns about the cost to the economy, right? Cost to Medicare and Medicaid, particularly Medicaid, as those that are not prepared for elder care expenses end up in a Medicaid situation, right? Where they're in a facility, nursing home, a Medicaid bed in a facility because they did not have adequate adequate care in place, right? And so states are looking at funding these. The first national program, or the first state program, public program, Washington State passed it a few years ago. It goes into effect next year, 2022, and it's the Long-Term Care Trust Act. It's going to pay benefits of up to $36,500. It's really only intended to pay for a year of benefit, a year of long-term care benefit. There will be a 0.58% mandatory payroll tax on all residents of Washington State. And so that contributes or that pays for this program. And what Washington State said was that there's an enormous burden on Medicaid for those folks that need care for a year or less, right? For those really looking at hospice and folks that end up in a nursing home towards the end of life, there's an enormous Medicaid cost. So they're shifting some of that cost onto this payroll tax system that they're creating. So states are looking at this, other states are looking at this as a model, but it is a burgeoning risk that the federal government is also evaluating. This plan, there's a plan that's proposed to Biden. He's reviewing it. It's called the WISH Act. It looks similar to this Washington State Act, and so there may be things that we see coming from the federal government in the future. But the point is that this is not really a plan to create a great elder care experience. This is for the government to shift some of the costs off of the federal system, right? And it's really only a year of coverage. So we can help our folks understand the risk, understand what the government's doing, and set them up in a much better position with a private plan. When we look at insurance trends, there's a great study out of LIMRA in Life Happens, the life insurance nonprofit organization. And coming out of COVID, they looked at 2020 and need gaps, insurance need gaps. There's a 43% need gap identified in long-term care insurance. And this suggested an active market demand of 110 million consumers. So that need gap is the folks that say they need or are interested in long-term care coverage minus the folks that already have it. And so 43% of folks are saying that they need coverage but don't have it, which this report identified as an active market demand of 110 million Americans. And so there's, this is the biggest market demand that they've seen in a long time, and it really spurred on by COVID and concerns that we have around elder care. And so as Andrew said, why is having a long-term care plan important? And we're going to get into the solution a bit here. But it is important because it is the greatest risk to our retirement portfolio, right? And as some of your financial planners, you understand the financial plan and addressing certain risks, right? But as we save in these qualified accounts or qualified funds, maybe a 401k, IRA, right? And we plan for a certain income, we don't often anticipate, in addition to the income we need for living expenses, we don't anticipate long-term care expenses that may come up. So if we have an income need of $80,000 potentially, right, and our living expenses are $60,000 in our retirement plan, we get into a situation where we need an additional $75,000 of long-term care expenses. Where does that come from, right? And so we're in a position where we draw down our retirement plan faster. Maybe we have enough to live, maybe we don't. Our goals for passing more money on to our kids or grandkids are interrupted because of this additional income need. And so we can reallocate with these plans, reallocate a part of our portfolio. And so I'll go back to this last slide, right? If we've well prepared for retirement, we have assets in the market, but we also have fixed assets, and maybe they're liquid in a money market, maybe they're in bonds, or something that's not earning significant return. And so why not reposition some of that in a solution like Secure Care? And this is what they call a linked benefit or hybrid long-term care plan, and it is a long-term care solution based on a life insurance chassis. And we base it on a life insurance chassis to be able to provide some guarantees that traditional long-term care insurance hasn't been able to provide in the past. And those guarantees are things like guaranteed life insurance death benefit, guaranteed premiums that never change, or a paid-up solution, guaranteed long-term care benefits, even a return of premium. Making this a liquid solution. Should we cancel our policy, we can get our money back. And so those guarantees are possible because it's built on life insurance. And so we'll go through an example here, and it's a simple example. We use $100,000 of our assets that we're going to reallocate. That's certainly not a minimum. That $100,000 is really just an easy number to see what the leverage looks like. But we'll take a 6-year-old female. And to give you kind of an ideal of the typical client, our typical client is someone that is in their late 50s, early 60s, folks that are evaluating retirement in the next 5-10 years, and they're starting to think about what the future looks like, right? And they're open to this conversation. I will say, because of COVID, younger folks are more interested in having this conversation. So we are starting to see, individuals buy policies that are in their early 40s or even 45, late 40s, and so it is broadening the conversation. But historically, our typical applicant is in their late 50s, early 60s. So to give you an idea, this 60-year-old female has assets. She's going to reallocate $100,000 out of her liquid assets, and it's going to create a couple of things. It creates a base death benefit or a life insurance policy, plus an attached long-term care policy that creates a total long-term care benefit. You'll see here this initial bar, that $100,000 creates a roughly $100,000 death benefit, and so it's not a death benefit like a traditional life insurance policy. It's really meant for return on investment. If I don't end up using this for long-term care, what do I get back? Well, you get back, return to you what you've invested in it, return back to your portfolio. But if you need long-term care, you're going to receive a monthly benefit. This benefit in this example is $6,882. It's going to pay out of this death benefit first. So it'll exhaust this first bucket of money we have, and that would take 2 years in this example. So we'd exhaust a death benefit in 2 years, and then it'd start to pay out of an attached long-term care policy, where in this example would last for another 4 years, which creates 6 years of long-term care benefit at $6,882 a month. Now, this is an example of a 6-year benefit. You can actually customize the plan. It can last anywhere from 2 to 7 years. 6 years tends to be the most common. It prices well in terms of the leverage it provides. But like I shared in a couple of slides ago, the average claim or average care need has been about 4 years, and in 2020 they increased it to 4.5 years. And so, a 6-year benefit really ensures that half the folks that have a claim of less than 4 years are covered, but the other half that have a claim that's longer than 4 or 4.5 years have a significant benefit that should cover a majority of their care need. So that tends to be the most common. In addition to a one-time payment, we do offer multi-pay options. You can fund it over 5 years, 7 years, 10 years, 15 years. And this table really gives you a good idea of what the benefits look like and why they're powerful. This chart shows an inflation protection. We offer inflation options. 3% compound is the most common option. There are 5% simple and 5% compound options as well, but 3% prices quite well. And so on this same 6-year-old, we're looking at day one benefits and age 85 benefits. So with a 3% compound inflation by age 85, the benefit has grown to this amount, $100,000 grown to $693,000 of long-term care benefit. You can see how much there's a little bit of a difference if we fund it over 5, 7, 10 years. You get the most leverage if you pay it up in one payment, but it's still significant leverage. Paying $6,667 over 15 years still gets you $500,000 of long-term care protection by age 85. Really where this is powerful is this tax equivalent yield. So if you look on the right-hand column, on a 100,000 single pay, on a 60-year-old, allowing it to grow by age 85, so over 25 years, provides a tax equivalent yield of about 9.5%. Down to the 15 pay, it's a little over 10%. And so really what that's saying is that if you compare this to an outside investment, maybe a market investment or something else, you'd have to earn at least 9.5% in a taxable investment. And we're assuming a marginal rate of 24% in this example. But you have to earn at least 9.5%, 10% in a taxable investment to equate to the same type of growth or leverage that this policy provides. And so that's really why this solution is powerful, because it addresses that concern your client has that why deal with insurance? Why go through this process? Why wouldn't I just invest it, right, and let it grow and then self-fund or pay for my care out of my investment, right? So certainly you could out-earn 10% in the market. That's certainly a possibility, but not on a guaranteed basis. This is a fully guaranteed solution. That 3% compound is fully guaranteed. And so if that person files a claim, they need long-term care at age 85, they're guaranteed this income stream to meet their elder care needs. That is that 9.5%, 10% tax equivalent yield. So this is a guaranteed solution, which really helps hedge against this risk well. And if you protect it against this risk well, then you can really focus on your investments differently. Maybe your other investments, you get more aggressive, or maybe you invest in that summer home that you wanted to, right? Because you've protected against this risk very well. Now, that income I mentioned is guaranteed. So what I haven't mentioned yet is there are a couple of ways that these benefits are paid out of long-term care policies. There's a reimbursement benefit, which is how insurance typically works, right? You have a claim, you file a claim with that insurance company, you have loss, or you've something costed you, right? And you're reimbursed what that cost or that loss is. With an indemnity solution like Secure Care, that benefit pays as income. So when a doctor certifies that you need elder care, and a doctor certifies that by a couple of ways, they have to meet a stipulation. The insured meets a stipulation that they can't do what they call 2 of 6 activities of daily living. So things like being able to get in and out of bed yourself, toilet yourself, feed yourself, those type of acts of daily living or life. If a doctor certifies you can't do those things, that you have issues with mobility, then that would approve you for a claim. Or someone that's diagnosed with a cognitive issue, whether it's Alzheimer's or dementia, that would approve the claim as well. So once we're in that situation, that approves the claim with Secure Care, and then we begin to pay these benefits as cash or as income versus the reimbursement type of benefit. And so that type of income really allows us to guarantee the benefit of this solution, because it's not dependent upon the type of care or what our care is going to cost down the road. And because it's indemnity and it's flexible, we can receive this income regardless of what our care is. That income can be used to pay a family member. If our spouse is providing care, that income, we can save that income and allow it to accumulate in our retirement assets. It doesn't have to go towards paid care if family is providing care. If we do have paid care, maybe it's not paid care through a licensed healthcare agency. Maybe it's paid care through someone in the community that we know that can provide a certain level of care, but they're not with an agency, and so it's a lower cost. And so we can save some money by using community-level care versus care through a licensed agency. And so this indemnity benefit really opens up and allows our elder care experience to be a bit more flexible. I mentioned these 4 guarantees, like guaranteed long-term care, a death benefit, return of premium, and reduced paid-up benefit. And so I'll mention the return of premium and reduced paid-up benefit here. The return of premium, we offer 100% return of premium if you cancel the contract with a 5-year vested schedule. And so after 5 years, you cancel it, you can get all your money back. That is on a single pay. And so it starts out with an 80% ROP year one, we cancel it, we get 80% back. It increases by 4% each year. So after 5 years, you cancel it, you get all your money back. On the multi-pay options that I mentioned, the 5, 7, 10, and 15-year options, those offer an 80% ROP until the last 5 years of your payment. And so if it's a 15-year schedule, it'd be 80% for 10 years. And then the last 5 years, it would start to increase. And so by the 15th year, you have 100% of the accumulated premium. You cancel it, you get that money back. There's a reduced paid up benefit as well reduced paid up benefit as well that if you're doing that 15 pay, let's say, and you decide to cancel it, you decide to stop paying premium after a period of time, maybe it's 5 or 7 years, you stop paying premium, the policy will not lapse. It'll be a reduced benefit that's somewhat proportionate to the amount of premium you've paid in. So at any level, the policy is designed that once you buy it, it's in place and it will not lapse on your client. All right, we're moving right through here. I'm going to just give a brief example or scenario on the power of a cash indemnity benefit over a reimbursement benefit. And so I think this might help in understanding the power of cash indemnity and why it's valuable to discuss with your clients. Traditionally, long-term care insurance and most insurance is reimbursement in nature, right? And because it's reimbursement in nature, we don't think of it as income, right? We think of it as a benefit in case of. In case of something happens to me, there's this thing that's going to reimburse me whatever my loss is. But this solution really is intended to be an income benefit that really gives a level of assurance to folks that they're going to get this benefit regardless of what future care may look like. If they need care, there is a benefit to be provided. And so it is somewhat different. If you have folks that have looked at long-term care insurance in the past, maybe that was a stumbling block. Maybe they said, well, I don't know what my care is going to look like. I don't want to be in a nursing home, right? So why would I buy this? Well, with this indemnity type solution, the conversation isn't, well, what if you end up in a nursing home? The conversation is, most folks that live a full life start to slow down. They start to lose mobility, and eventually they need some help, right? And if you need some help, there's a solution that can provide you additional income to meet those care needs, right? Whether it's family, whatever the solution ends up being. Right, and so there's an additional opportunity with these type of indemnity solutions. So we look at an example here. We have a reimbursement policy and a cash policy, and we'll just assume that the benefits of these policies are the same. Right, day one, $400,000 roughly. At age 80, it grows to $1 million in benefit. We start out at $5,000 a month. It grows to $13,000 a month. And what's true of elder care is that it's progressive in nature. And so if we assume at age 80 this individual needs care, right, most folks receive care at home first. They receive it from family. And so your traditional long-term care policy that's reimbursement does not pay you if you don't have qualified long-term care services being received. And so there's not going to be a benefit paid in those early years that family is coming around and providing that care. Well, with the cash policy, we're going to pay that full benefit regardless of the care need. And so in this 2 years, $326,000 is paid. Let's say from ages 82 to 83, the next 2 years of care, we go to home health care and we're paying someone to come to the house. But the projected cost is $110,000. It's not the full amount of what our policy could potentially pay. And so that reimbursement policy is limited to whatever the cost is, $110,000. Whereas the indemnity policy continues to pay the max. It continues to pay that max income. In your final few years of care, maybe you go to assisted living, and the reimbursement policy has an assisted living cost of $210,000, and they reimburse that cost. Whereas the indemnity policy continues to pay the max income. And so over a 6-year period, with this progressive nature of care need, the reimbursement policy, it has reimbursed the cost of care. And so in that term, it's done a great job. It's reimbursed our cost. The family didn't have to come out of pocket, and so that's wonderful, right? But with the indemnity solution, it has paid the max income regardless of the care need, up to $1 million of benefit was paid. And so really that's the conversation is this new solution that's indemnity, that's cash, creates an opportunity to receive income and envision care in a different kind of way.
Hey, John, this is Andrew. This is a great
Yes,
way. I've
Andrew.
never actually looked at it as an income as opposed to long-term care benefit. But we talk about how death benefit really is not a priority in these types of products, and death benefit is just a return of premium. However, in this situation, the client received care reimbursed at $320,000. But really, the difference between that million and 320,000 went into the client's checking account, and when the client passed away, that's really a death benefit to the beneficiaries, children, spouse,
That's
etc.
right.
And now they can use. So I just wanted to point that out.
That's right.
That's a great analogy.
Absolutely, Andrew. No, you're right. It does. It goes into the client's portfolio, into what they could potentially pass along to their heirs. Yeah, and as a qualified long-term care product, the IRS allows that long-term care benefit to be paid tax-free. So death benefit and long-term care benefits are paid tax-free. There is a limit to that, so just a caveat here that the IRS allows for indemnity long-term care benefits. They allow them to be paid tax-free up to what they call the HIPAA per diem LTC amount. Which in 2021 is $12,000 a month. And so someone could receive $12,000 a month, no questions asked, tax-free from these type of solutions. And that is indexed for inflation, so it does increase over time. And so the assumption is whatever the policy size is, the inflation of that per diem amount would probably keep up, right? But in a given scenario, maybe it's someone that's in Manhattan, and they're going to a really nice facility, and it costs $30,000 a month. If they get more from their policy than that per diem amount, as long as it's paying a qualified service, long-term care service, it's still tax-free. So the caveat is that if it's over the per diem, then to stay tax-free, it's got to go towards qualified services. So just a caveat there on taxation. And then finally, I'll mention the tax benefits briefly, and then we'll close, and I'll pass it back to you, George, for comments and questions. But from a tax standpoint, the IRS does allow for some tax deductibility of long-term care premiums. And so the way that Securian has structured our product, because it is based on a life insurance chassis, life insurance premium is generally not deductible. The IRS specifically says in the Internal Revenue Code that you can't deduct any premium or anything that comes from policy cash value or is paid into policy cash value. And so when we designed the product, we designed it with a double policy structure so that when premium is paid, part of that premium goes into the policy life insurance, and that goes into policy cash value. The other part of the premium that makes up long-term care cost, is held separate, and that never goes into the policy cash value. And so the long-term care cost, it pays for long-term care directly. So that long-term care portion of premium pays for long-term care directly and allows for some potential deductibility. And there are really three levels of opportunity. There's the individual pass-through entities like an S Corp, or a business like a C Corp, right? And so there are really three levels of opportunity. For an individual, the IRS says can deduct premium that goes towards long-term care expenses up to what they've set out as age-based limits. And you see that on this graph over to the right, from ages 40 through 71, plus there are different limits. So on an individual that's age 61 through 70, the IRS says they can deduct potentially up to $4,520 of the premium that pays for long-term care. And so for an individual to get this $4,500 deduction, It is part of the medical expense deduction, which if you're familiar with that, it requires to take a deduction, you have to have medical expenses and other associated expenses that exceed 7.5% of the adjusted gross income, or AGI. And so there is really a limited opportunity maybe for an individual, unless they have other medical expenses or their income, their adjusted gross income is low. More than likely, they may not be able to take advantage of this deduction. So that is limited for an individual, but for a S corp or small business owner, right? They're able to take this age-based limit. In this case, a 62-year-old, let's say, $4,500 deduction. It is a straight line or above the line deduction. So they don't have to meet the 7.5% AGI requirement. So an S corp owner can purchase a policy, deduct $4,500 if they're 62 above the line, and that can be a significant tax arbitrage opportunity for a small business owner. In most cases, when we look at a plan for someone that wants to take advantage of the deduction, we probably structure it as an extended pay versus a single pay. So maybe fund it over 10 years or 15 years, but fund it at $5,000 a year over 15 years, or maybe $8,000 a year over 10 years, and then be able to deduct a good portion of that premium. One other opportunity for individuals is funding from tax advantage plans like medical savings accounts or HSAs. So this age-based limit, whether it's $1,690 on a 55-year-old or $4,500 on a 62-year-old, that amount could be funded towards the premium from a health savings account, an HSA. So for those individuals that have accumulated assets inside of an MSA or an HSA, they can use those funds towards this type of plan. So there is a great opportunity there. And then when we're talking businesses, so these plans are increasingly being used in executive carve-outs or plans for key executives or key folks in organizations, that as organizations are looking to expand benefits that they offer to some of their key employees, this is a fantastic benefit to look at adding in an executive plan. And so a C Corp has the ability to deduct 100% of premium. If the employer, the business, pays for the premium, they can deduct 100% of that premium for the benefit of their employee. And so it's a great opportunity for the business to get a deduction. The employee gets this fantastic long-term care benefit. Because it's a benefit to the employee does have to claim a portion of that premium as income. Generally, it's the amount that represents the life insurance part of the premium, and it's generally about 40%, somewhere between 40 to 50% of premium they might have to claim as additional income. And so let's say the business funds $10,000 a year for 10 years. They deduct that $10,000 each year for those 10 years, and the employee may have to claim $4,000 each year as additional income. And so great opportunity there if you're in that small business space and you do executive carve-outs. There could be a great opportunity for planning there. So we're at about 40 minutes, just past, George. I don't want to carry on too long, but hope that some of my excitement about the opportunity that's ahead of us in helping our elders plan for better years as they need care has come across, and you've seen some opportunity with this solution. There are several great solutions across the market. We happen to be one of the few indemnity carriers that offers this cash income benefit, and so I think we're uniquely positioned. Because we're a great company with great financials, we're actually priced incredibly well also, and so we happen to have the benefit of being one of the top products in the market right now, which as a sales guy I appreciate, right? But to you can know that if you look at Securian as a solution, it's one of the premier priced products as well, and so your client's getting one of the better deals in the market. So George and Andrew are experts. They know our product well. We talk frequently, and they know all the products incredibly well. And so absolutely lean on them as a resource. They're familiar with this tax deductibility and taxation and can talk with you at depth and help with these executive carve-outs or other opportunities that you have. And so I'm thrilled to partner with them, and I know that they'll be a fantastic resource for you as well. So
hey, John,
appreciate
this
the
is
time.
Andrew. Thanks
Yes.
so much for the presentation. I just want to quickly say we have a question coming in here from the audience, and the question is, does Securian also have an annuity hybrid LTC product? Do you know the answer there?
Oh, great question. We do not have an annuity hybrid product. No. It is something that we're planning potentially in the near future, but do not have one currently. No.
Thank you so much. By the way, we do have access to an annuity with an LTC rider, so please reach out to me, Andrew, or George, and we'll hook you up with that solution, which could work well,
Yes.
especially if we're maybe considering a 1035 exchange scenario, both full or partial from the non-qualified annuity.
Yeah, absolutely. There are a few good annuity solutions out there. Yes.
Okay, I'll jump in here and thank you, John, because that was really fantastic, and I think we all gained a much better appreciation of how families are increasingly challenged by long-term care and seeking support to address these needs. And we also learned about ways these households are changing, and this is fueling that greater now demand and interest. And so the ears and the minds are open, looking for solutions, and that is a great opportunity for us all to deliver on. And we all learned here throughout the presentation, your positioning of indemnity as income, as Andrew pointed out, really is a new vocabulary. I love benefit control, but looking at the income benefits of indemnity are really a new turn on that. So I really enjoyed your presentation. And I'd like to begin to close here by just inviting everyone to reach out to Andrew, Rod, or myself and let us share more, such as best practices in opening an LTC conversation. That's where really things begin. How do you open a conversation on this subject? And then possibly take a deeper dive into specific cases using illustrations, presentation materials, and then along with providing you direct access to a vast library, along with the carrier presentation materials, we have a library full of sales videos, category white papers, needs analysis templates. You may need a guide through some of it because it is pretty all-inclusive, but it would be our pleasure to give you access to this, everyone on the line. We appreciate your time. So we would look forward to contacting you in the future, in the weeks ahead, and offer you our support. Again, we thank you for taking your time today, and this will conclude our webinar. Thanks again to all.